In September 2019, something broke in the American banking system that most people never heard about. Overnight interest rates, the rates banks charge each other for short-term loans, suddenly spiked from 2% to 10% in a matter of hours. Banks that normally lend to each other without thinking twice suddenly stopped. The Federal Reserve had to inject $75 billion into the market before lunch just to keep the gears turning. By the end of the week, they'd pumped in over $250 billion. The financial press covered it for a day or two, then moved on. But here's the thing. That moment revealed something most people don't realize. The global financial system, the thing that lets you buy coffee in Tokyo with a card from Ohio, that keeps pension funds solvent and governments operational, isn't held together by math or gold or even trust. It's held together by a network of secret agreements, emergency backup plans, and the constant invisible intervention of central banks, who've essentially become the financial system's life support machine. We talk about the economy like it's this natural force, like weather or gravity. But the global financial system is actually more like a controlled demolition that someone's decided to film in reverse. Every day, trillions of dollars move between countries, banks, corporations, and individuals. Money that doesn't really exist in any physical sense gets credited and debited across borders at the speed of light. And somehow, when you wake up tomorrow, your bank account will still show the same number it showed today. Your mortgage payment will clear, your salary will hit your account, the gas station will take your credit card. All of this feels normal, but it requires a level of coordination and intervention that would make Cold War military operations look simpler by comparison. Think about what has to be true for this to work. A bank in Germany has to trust that a promise from a bank in Singapore is actually worth something. A pension fund in California has to believe that bonds issued by the Japanese government will pay out in 30 years. Every single participant in this system has to wake up and decide that the digital entries in their ledgers represent real value. And they have to make that decision knowing that everyone else is making the same leap of faith at exactly the same time. It's not quite a mass delusion, but it's not quite rational either. So how does it actually stay together? The first answer is central banks, but not in the way most people think. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, these aren't just institutions that set interest rates and print money when the economy needs a boost. They're the hidden infrastructure that keeps the entire system from experiencing the financial equivalent of a power grid failure. Here's what they actually do. Every major central bank has something called swap lines with other central banks. These are essentially agreements that say, if your banks run out of dollars, I'll lend you dollars. If my banks run out of euros, you'll lend me euros. These lines were made permanent after 2008 because that crisis revealed something terrifying. Modern banks don't just need their own currency. They need every major currency, all the time, because they've made promises in every major currency. A German bank might owe someone dollars on Tuesday, yen on Wednesday, and pounds on Friday. If they can't get those currencies exactly when they need them, the dominoes start falling. During COVID, central banks activated these swap lines and moved over $10 trillion between themselves, not to save the economy in some abstract way, to literally prevent the system from seizing up like an engine without oil. The Fed became the de facto lender of dollars to the entire planet because, and this is the uncomfortable part, the entire planet runs on dollars, even when they don't realize it. About 60% of global trade is invoiced in dollars. Roughly half of all cross-border loans are in dollars. Even countries that publicly despise America need dollars to function. And the only institution that can create unlimited dollars out of thin air whenever it wants, for whatever reason it deems necessary, is the Federal Reserve. But central banks are just the first layer.
Underneath them is something called the shadow banking system, which is a terrible name because it makes it sound illegal or secretive when it's actually just boring and complicated. Shadow banking refers to all the financial institutions that act like banks but aren't technically banks. Money market funds, hedge funds, insurance companies, pension funds, investment firms. They take money from people, they lend it out, they make promises about returns, but they're not subject to the same regulations as banks, and they don't have direct access to central bank emergency funding. Here's why that matters. Let's say you have a money market fund, basically a place where people park cash and expect to get it back immediately with a tiny bit of interest. That fund takes your cash and invests it in short-term loans to corporations and governments. Safe stuff, or at least it's supposed to be. But in 2008, the largest money market fund, the Reserve Primary Fund, broke the buck. That's industry jargon for they couldn't give people their dollar back for every dollar invested. Seems like a small thing. It caused a complete panic. Within 48 hours, investors tried to pull over $300 billion out of money market funds. If that had continued for another week, companies wouldn't have been able to make payroll because they couldn't access short-term credit. The Fed had to guarantee every money market fund in America just to stop the bleeding. The shadow banking system is now larger than the traditional banking system. According to the Financial Stability Board, it's around $235 trillion globally. That's roughly 240% of global GDP. And it all operates on the assumption that when things go bad, central banks will step in and save it, even though central banks aren't legally required to, and shadow banks aren't supposed to be their problem. It's like building a second electrical grid next to the first one, refusing to call it a grid, and then expecting the power company to fix it when it catches fire. Now we get to the really strange part. The system doesn't just run on money and trust, it runs on something called collateral. And the same piece of collateral gets used over and over again in ways that would make your head spin. Let's say you own a US Treasury bond. That bond is considered the safest asset in the world, the thing everyone trusts. You take that bond to a bank and use it as collateral for a loan. The bank now takes that same bond and uses it as collateral to borrow money from another bank. That second bank uses it as collateral for something else. The same bond is now supporting 3 different transactions. This is called rehypothecation, and it's not illegal or even unusual. It's how the system works. Estimates suggest that the average high-quality collateral asset gets reused between 2 and 3 times. During the 2008 crisis, some pieces of collateral were reused up to 4 times. Think about what that means. If one transaction in that chain fails, the entire chain is suddenly unstable. It's like a game of musical chairs where everyone's sitting on the same chair, and they don't realize it until the music stops. In 2011, when MF Global collapsed, they'd taken client assets that were supposed to be segregated and untouchable, and used them as collateral. When the firm went under, clients couldn't get their money back because it had been pledged to someone else, who had pledged it to someone else. The collateral chain had knotted itself into something that couldn't be unwound without destroying value. And here's the kicker. No one actually knows how many collateral chains are out there or how interconnected they are. There's no central registry. Banks report their own exposures, but they don't all